Mark Solon here from Symmetry Financial. We're going to present to you for the next 45 minutes or so on a topic hopefully that will be relevant to all of you and certainly of interest to some of you. What I'm going to try and do for the next 45 minutes, and I'm on the clock here, is to make mortgages interesting, which is a tough task, but it is my job and I do it for a living. So hopefully at the end of the next 45 minutes, if nothing else, you're going to be walking away with more questions than you would have had before. And hopefully you'll be walking away with a little bit of information and a little bit of knowledge on mortgages that you didn't have heretofore. Okay? So what are we going to get into straight away? We're going to get into a little bit about the company first of all. So Symmetry Financial, we're trading just over 2 years, so almost 2.5 years. However, it was a split from another company. So in terms of independent brokerage business, we've been trading for the best part of the last 7 years. In 2017, we won the Mortgage Broker of the Year award. So it was under the previous brand. However, all the staff came across to Symmetry Financial when this split occurred. Currently, we have 8 full-time staff, and we're in the process of adding a couple of additional staff to the company as we speak. So in relation to what I'm going to talk to you about for the next 40 minutes or so, and I'm going to be taking questions as well. So for those of you that are aware and are familiar with Zoom, there's a little chat function there, and I would encourage you to send through any questions you might have, scenarios. So I am going to be giving examples in relation to how the banks operate, how mortgages are worked with the banks. So I'm going to actually show you the calculators from the different banks. So if you do have any scenarios you'd like me to run through, or if you're just happy for me to work off the templates that I've set up prior to the presentation starting. Either way, you'll definitely have a better knowledge than you did before this seminar started. So we're going to get into mortgages, a little bit of background. I'm going to talk about the property area, the property market, what's going on in the property market. You can't ignore the property market and talk about mortgages. So I'm going to talk about that for about 2 minutes. Then I'm going to get into the details around mortgages, how much you can borrow, who you should borrow from, how long you should borrow for, what type of mortgage you should take, so the fixed option versus the variable option, or indeed you can go with what's called a split option. So you take a little bit of variable and a little bit of fixed. So you have all these choices that are thrown at you when you start talking to banks. Maybe you already have a mortgage. So maybe you're listening to this seminar this afternoon and you already own a property. Maybe you're considering moving house or looking to switch and review your mortgage. So all these various options that we can look at. And ultimately, we're going to talk to you about how you can save money over the term of a mortgage. Okay. So first of all, getting into the property market, going to look at it from a country point of view, and I'm going to look at it from an Irish point of view. So these figures are month on month. So what's happening in terms of the national price of property? So the average price countrywide, excluding Northern Ireland, is €260,000. That's actually up. This is as of the end of July. That's up from the June price, average prices of approximately 2.3%. So obviously we're all familiar with COVID because this seminar is happening remotely and over the internet. But COVID came into our world earlier in the year, and in terms of the property market, even the banks were speculating that it was going to have a knock-on impact on prices. And while it did in March, in particular in April and May, there has been a bounce back in the price going into June and July as people started realizing that there's going to be an element of normality to this. It was obviously getting used to the new norm. And once that started happening, then people started getting interested in property again. Maybe it was you're living at home with your parents and been allowed to work from home by your company, but you're having to work from your bedroom. Or maybe you're sharing a 2-bed apartment, and while your roommates are fine in an evening or maybe at the weekends, seeing them 24/7 wasn't exactly what you signed up for. There certainly is an element of that when we're seeing it, when we're asking our clients what is the reason for them looking to buy. Obviously rents as well, you can see rents have actually held steady, which is the most confusing part of the whole thing. Again, with people maybe moving home or moving back out of the capital, rents have actually held steady. And when you're looking at Dublin, the average price on property in Dublin is up just under 3% month on month. And I'm going to be looking at it in terms of the year in a second. And rents, as you can see there, I don't know how anybody can rent in Dublin at the moment. Been perfectly honest with you, because a mortgage would cost about 60% of that rent. An average mortgage would cost significantly less than that type of rent would be on a monthly basis. So, and again, I'm going to show you how all of that works. So that's the picture of where we're at today. There wasn't a significant drop in property assets that people were expecting because of COVID. Again, various reasons for that, and that can be discussed on another day. In relation to year-on-year changes, again, it's interesting to see what's happened between 2019 and 2020. Over the last 12 months in Dublin, there's actually been an increase in the price, while nationally it stayed steady. And in Leinster, there's been an increase in the price, again, while nationally it stayed at zero. But that's masked by the fact that there was a drop in Munster and a drop in Connacht Ulster. Dublin and the greater Dublin area and Leinster has seen a steady continuation in terms of property asset price. The requirement and the demand is still there. So that would lead on to why is this happening? It's very much down to supply. So all products and all assets are supply and demand driven. So if you look at the property market in Ireland, and I just took this off Daft, it's a very interesting graph if you're into these things. It's the supply of property over the last 10 to 12 years. So you can see there was anywhere between 40 to 60,000 units available up until about 2013, 2014. It starts dipping and it's been on the way down ever since. So what that's telling you is we're not building enough property. And again, you don't need me to harp on about this. You can read it every single day in any of the broadsheets or on their online news feed. So that's the ultimate problem that is facing the majority of people. There aren't enough properties out there for the demand that's generated by the market, okay? You can see there the numbers in terms of the properties available this year versus last year. It's down 22% nationally, and that's 16% in Dublin. So we just don't have enough product, as they would say. Okay, so what is a mortgage? So moving into the actual topic of the presentation. So what is a mortgage and how does it work? So a mortgage is basically a loan. You may have a loan at the moment, and you may have had a loan in the past. So a car loan, a holiday loan, God forbid the old student loans. A credit card is a form of a loan, but with no termination date. A mortgage is typically a longer term loan, and it's used to buy property or land. And the mortgage is secured against the property, and that's secured by taking ownership or access to the title, which is then held by the bank. So every property or every piece of land has a folio number, and it's registered with land registry, and then your name goes down on this little piece of document, which is the title. And when you take out a mortgage, the bank hold that document or the title as security until you make that final payment to the bank. So 35 years time, the mortgage is cleared. You now receive the title document back out to your solicitor, and then you have to decide where you want to keep that document. Okay, it's typically going to be the large transaction and probably the most expensive financial product that you'll undertake throughout your working career. So choose wisely, and that's hopefully where we're going to help you today. Okay, so where do I start? Goodness me, when I was putting this together, there are any number of areas we can start, but the first one would be to research the market. So what are we talking about there? A lot of people there's a lot of misconception out there that mortgages are all the same. Okay, so obviously from our perspective, we understand the industry, we understand the market. There are literally dozens of different types of mortgage products available to the consumer. It's confusing for me, and I do honestly mean that. I've staff here who we, occasionally calling in, you're on a phone call with a client and you're shouting a query or a scenario over to your staff to see if they've dealt with it before, because it's new. Every single mortgage application is unique, and it's unique to the individuals applying. And because of that, the rules that particular bank apply have to be interpreted to suit that particular scenario. Okay, so hopefully you'll understand that as we go through the examples. So first of all, what type of buyer are you? Are you a first-time buyer? Are you a second and subsequent buyer? So this is new terminology, this SSB, second and subsequent buyer. You'll start seeing this, or you may already have seen it, popping up in literature and communications. It used to be called, or it's still occasionally referred to as the home mover, but you may be holding on to your property. So you're a second and subsequent buyer. You could be moving for the third time. And then you obviously have the property investors, and that's a big percentage of the market as well. How long do you want to borrow for? Again, it varies from bank to bank. So some banks will allow you to borrow up to the age 65. some 67, some 68, some 70, and there's even banks now that will lend up to age 75, although there is a caveat there. The age 75 is for mortgages that are for investment properties only. Okay, so it's called a buy-to-let mortgage. And then you have to be able to prove repayment capacity or repayment ability. This, believe it or not, is the first test that we undertake when we're carrying out a review of a potential applicant for a bank, is can you show me proven repayment ability or demonstrated repayment ability? Again, all the banks have different language for this, but it's basically show me over the last 6 months how you can demonstrate to the bank affordability for this loan. That's basically what they're asking. You could have a salary of 100,000 euros. You could have 100,000 euros of a gift coming from an extremely wealthy and generous relative, but you don't have any repayment ability. You won't get a mortgage. Okay, it's as simple as that. You have to have demonstrated repayment ability, averaged over a 6-month period. Are you married? Are you partnered? And if they're applying, is there any variable income? So variable income is things like bonuses, commissions, shares, health insurance contributions, car allowance, allowances in certain careers. If you work shift work, if you work weekends, if you work nights. So all of these fall under the variable income on top of your basic income. And it is quite prevalent across a lot of industries now, where individuals are remunerated or paid across 4 or 5 different terms. And it's understanding that and then presenting that in the right way to the bank. Are you in the public sector or the private sector? So the majority of people listening today, I'm going to assume, are in the private sector, but you might be partnered or married to somebody in the public sector, or you might be partnered or married to somebody who's self-employed. Again, completely different rules for the self-employed world than there are for the public and private sector. If you are, or you know anybody in the public sector, the good news is the banks treat you differently in that you're seen to be a safer pair of hands, and 2 banks in particular will lend more money to a public sector individual than they will to a private sector. Okay, and again, if it's relevant and anyone wants to throw the question up on the chat, please feel free to throw it up there and I can address it as we go along. So again, 3 different scenarios. If you're self-employed, again, we deal a lot with self-employed, maybe through a partner or a spouse that has their own business. Again, it is a large percentage of the employment market in Ireland. They have to have 2 years trading behind them before they can apply for a mortgage. And again, if you're thinking about setting up your own business and you're also in the process thinking about buying your first home, you need to be very careful there, because you will need 2 years trading and successful trading before you could apply. Have you saved? How much have you saved? So what's your deposit? Are you getting a gift? Are you selling assets? Okay. And do you have any existing loans? So do you have a car loan, a credit union loan, an existing mortgage, a credit card? Again, all of these things have to be recorded as part of the application with the bank. Okay. Ideally, when you're applying, we would recommend you use the broker market. So obviously I'm singing from our perspective as a broker. You don't have to. You can go directly into the bank. The challenge with that is when you go into the bank, you're only getting the one scenario or the one picture. Now, it might be sufficient for what you need, brilliant. However, there can be better rates out there, better products out there, better overpayment options out there, incentives which some of the banks give and some of them don't give. So there's these big, I would call them big flashing lights now that the banks are using. You see it in the bus shelters. You know, walking home, or you're driving through the city or around the country, the banks are advertising on bus shelters, hoardings, online. I get it on my social media feed all the time, and the banks focus on the incentives. They don't focus on the product, and the reason they don't is because it's extremely profitable for them. Okay, so again, brokers, and a good broker should be a one-stop shop to take you through all the options, understand the process so that you explain the process so you understand it, and basically then driving it along for you, so representing you. The biggest challenge people will get by going directly with a bank is once you've actually applied, your application when you've gone in with the bank is the exact same as if you've gone with a broker. So the mortgage goes to the exact same location. It goes to the broker center, their broker headquarters. Okay. The difference now is with the bank, you typically have to deal with a customer service number and you don't have somebody looking after your application for you. So you have a different person who you talk to every day when you ring up to chase it. Whereas with the brokers, you should be talking to the same person, or at least a smaller pool of individuals, and they're motivated to get that case driven along on your behalf. Okay. The difference is a broker is representing you, they're not representing the bank. Okay. Again, variable rates versus fixed rates. This is a debate that's ongoing in Ireland. Fixed rates are a no-brainer at the moment. Why is that? Because all the banks have priced it that you're going to go on a fixed rate product. Okay, but rates vary as low as 1.95 and as high as 4.5%. That is a significant difference if you haven't shopped around. And then longer term over shorter term, we see it all the time. The banks will always talk to you about taking the maximum term, always the 35 years if your age allows. The reason for that is it's the most profitable option for them. Again, is it right or wrong? It's just that if you are aware of that, then and you decide to go with 35 years, then you're making an informed decision. But it's very unlikely that the bank are going to say to you, we're going to go with the 35 years here with your mark because that's the most profitable product for us. That's not how it operates. That's not how it works. If you can afford to go shorter, we would encourage you to look at a shorter term. A lot of people are paying high rent. So we would generally look at what's the cost of the mortgage with the additional costs, so property tax, the insurances, what's that figure, what's the rent, and if you can match it or go close to that figure, then you're going to be onto a win-win. What actually generally happens is you're paying a couple of grand in rent or 1,800 euros in rent. The mortgage is going to cost you 1,200 quid, and the bank sell it on the basis that you're going to have 600 euros extra to spend on miscellaneous expenditure, and you're walking out of the bank thinking, woohoo, 600 euros extra for me to spend at the weekend or go shopping or whatever it is, whereas the bank have just taken the absolute maximum profit from you over that 35-year period. And again, you'll see this in a second. There's cashback incentives out there, and or are you interest rates? So which approach is right? So cashbacks, they have a place, I can't argue. The main banks that are peddling the cashback offers will be Bank of Ireland, EBS, and PTSB, with very attractive cashback incentives and offers for first-time buyers. And then interest rate driven tends to be KBC, Ulster Bank, and the new lender that's only just entered the market, Avant Mortgages. Again, they're very specific. They're not mainstream yet. They're looking for very, very specific products, but they will. It's very encouraging that they've entered the market, but to put it into context, they're in a few weeks at this stage and none of the banks have moved their rates as a result, which tells you that Avant are going after a very, very specific niche in the marketplace. Okay? So a few tips when it comes to apply. It does make sense to have your AIP in place before you start looking at property. So we get asked this quite regularly. Why does it make sense? Well, number one, you know what price range you can look at. So instead of having the dream and looking at on Daft or on My Home and you're looking at properties for 450,000, 500,000, and then you come along and you talk to a bank or a broker and they're saying, well, based on your numbers, based on this, based on that, you're only going to get a 300 grand mortgage. It's leading to disappointment. Now, doesn't mean that you can't aspire to it or save and save and save to build up the deposit to allow you to buy that higher priced product. But having the approval in principle brings an element of reality to the purchase process. Okay. The second reason is if you do go looking at property and by chance you see a property that you like and it says that sparks something with me, I can see ourselves living here, might need a lick of paint or new carpet, but this is our home I want to live in for the next 10 years, or I want to grow old in. The seller will only take an offer. Most agents will now only take an offer if you can confirm you have approval. Okay, some might allow you to bid, but when you get into the busy end of the bidding, they're going to ask you for confirmation that you have your approval in principle in place. Some banks will give you AIP literally within a 12 to 24 hour period. Again, I'm not going to mention those banks if you've been through it. If you've gone in and you've got AIP in a 12 hour period or even a 2 hour period, that AIP is just about worth the paper it's on. You haven't been financially assessed, you haven't been financially underwritten. Yes, it's allowing you going out to bid on the property, but in reality, it's as useless as the sheet of paper that they printed it on. Okay, approval in principle should take up to 15 days for assessment. And why am I saying 15? Typically, it's 5 to 7, but with the banks and with queries they may have on your accounts and questions on your scenario, it can take up to 3 weeks. Okay, just that you're aware, bank to bank, it varies, and it varies at different time frames based on the volume of business that's been transacted. At the moment, all the banks are way behind on their service level agreements because of the volume of business been processed through. Okay, don't panic. If Vincent's asked the question, can we share the slides? Yeah, absolutely. Don't panic. Can we, you're more than likely going to apply for a mortgage with your main bank. Okay, that's who you've banked with since you've been a kid. Again, going in with your eyes wide open, not just because it's a nice, warm, fuzzy environment. You can apply to more than one lender. You can get your scenario assessed by more than one lender. I'm going to show you in 5 minutes at the end of this presentation. I'm going to assess with 3 different lenders, okay, to show you how complicated or not actually the process is. Okay, comparing rates is really, really important. Okay, so why am I saying about you're more than likely going to go with your main bank? Banks have a habit of recruiting you when you're 10, 8, 10, 12, back in primary school or back in secondary school, going into your local school, signing you up. Using myself as an example, I'm a Leitrim man. I have 3 bank accounts from 3 banks from the main street where I went to school, and that was back, give my age away, over 20 years ago, let's just say. Okay, so what was the methodology behind that? I was absolutely valueless to that bank as a 15-year-old, as a 13-year-old, even as a 20-something-year-old. But then as you progress through your career and you're looking to take out loans, you're looking to take out credit cards, you're looking to take out mortgages, which is the most profitable product available, that is what it's about. You'll tend to look at your main bank, and that is a long-term strategy from the high street banks. And because of that, they do tend to get away with charging a premium a little bit more than some of the non-high street banks. Okay? Always look at the interest rates. Whether you whether you avail of the cashback offer or not, that's a decision. Again, it should be an informed decision that you're making. However, I would always recommend that you focus on the interest rate as part of your decision making. Okay? What's the cost of that loan going to be over the duration of the mortgage? And if I have literally 2 minutes here to show you a tool that you can all use after this presentation is over, and it's readily available to everyone, and I always get the name of it wrong. CCPC is what I call it, the Competition and Consumer Protection Commission. So we've just, as a company, Symmetry, we've just launched our own a new website. We put a bit of money and a bit of time into it. The marketing company developing the website were going on pushing us about building a mortgage calculator. And my answer to them was, why would I replicate something that's already perfect and it's somewhere else available? And this is the answer. So the CCPC website, very simply, and I'm going to use 350 as the property price, 315 as a mortgage, just to try and keep consistency throughout the presentation. They will give you all of the different products over the different time frames. So you're actually seeing it there. So when I mentioned there earlier about variable, so you have the variable options, then you have 1, 2, 3, 4, 5, 7, and 10 fixed. Don't ask me why there's no 6-year fixed, no 8 or 9-year fixed. It's 1, 2, 3, 4, 5, 7, and 10. And not all banks offer fixed rates for all of those timeframes. It varies from bank to bank. But if we take the average, the 3-year fixed, so if I'm going in here to look at the 3-year fixed, I'm going to look at Avantcard. I'm going to say look with KBC, and there's ICS. So the 3 banks that come up straight away wouldn't be what you would call the popular high street banks. They're the 3 cheapest. ICS Dillusk, ICS Mortgages is ICS Dillusk. They don't even have a high street presence. Okay. Avant Money, they don't have a high street presence, and then KBC tucked into the middle there. Then AAB, Haven, which is AAB, ICS coming up, Finance Ireland, again, they don't have a high street presence, EBS, Permanent TSB, Bank of Ireland, all down there at the bottom. So what you do when you tick, and I'm not saying not to include them, so let's take out ICS, okay? And let's go down to Bank of Ireland, because we all bank with Bank of Ireland, don't we? So what you then have is an awful lot of information here, and I went for the 30-year example. What you're basically looking at is the initial interest rate, okay? So you can see the difference in rates. What happens after that fixed rate expires, so you have what's called a roll-off rate. Again, if you do nothing with your mortgage, and we see this all the time, a letter comes out, you stick it under the microwave or in the cupboard, in the fridge, you promise that you must get to it, and it's 12 months later, you're talking to somebody like us and say, Christ, yeah, that letter came out from the bank last year, and I never did anything with it. I know my mortgage was up by 20 quid or 30 quid. And that's typically all it is, 20 or 30 quid a month. but that 20 or 30 quid is pure profit for the bank. Okay, so you have what's called the roll-off rates, and then you have the total amount repayable if you never reviewed that mortgage after the day you took it out and the rates stayed as they are on this example. So you'd have Avant will cost you 460, Bank of Ireland will cost you just under 560, and KBC just over 486. Okay, so and there's an awful lot of more information then buried down in there in relation to can you overpay or not, what type of terms are available with the bank, because some banks, if you're on a fixed rate, will allow you to overpay. Other banks won't. Again, it varies from bank to bank, but a super tool, and it takes all of about 3 minutes to do the calculation. If you're a switcher, if you're a home mover, it's the same thing. It's just different products. Okay. So that's the CCPC website. Hopefully you're all familiar with that in relation to other financial comparison tools. So an example of a property purchase. So just to talk you through what happens. So if I'm looking at buying a house for 100,000, now there's not many of them out there. I've just shown you the average nationally is 260, and in Dublin is 380. So there's not many 100,000. The reason I'm using 100 is that the numbers will hopefully resonate with you. So the first thing you have to do is you have to bring a deposit to the table. If you're a first-time buyer, you get away with a 10% deposit. So in that example there, it will be 10,000 euros. I'm now taking out the mortgage for the balance. And the mortgage is what's called loan to value. The loan based on the value of the property. So this would be a 90% mortgage because 90,000 is 90% of the value. So that's what loan to value means. You have to pay stamp duty, that goes to the government, it's 1%. You have to pay legal fees and outlay. Again, be careful here because solicitors can be quite sneaky and they can include, I'm sorry for any solicitors in the chat today, but they can be, not all of them, and they'll include their legal fee, which is called the conveyancing fee or the professional fee, in with all of the other charges, so the stamp duty, outlay, and you may not know what the legal fee, the fee that the solicitor is actually charging you. They should give you a breakdown in the total cost. Legal fees are anywhere from 850 euros up to some silly numbers that you see. I've seen 3,000–4,000 euros been quoted for legal fees, and that's just a professional fee alone. Okay, because banks are given this cashback incentive, you might see that some individuals might say, well, okay, the client is getting back 8,000 euros from the bank to cover their costs. You know, if I pay if I add a little bit extra on here, they may not notice. Okay, but again, that's legal fees and outlay. You should again look for a breakdown in costs before you proceed with the solicitor. And this is at sale agreed. You've now gone sale agreed. You can ask a solicitor for an estimated breakdown of costs based on the value of the property you're buying. So again, just to repeat, you have the purchase price, you have the deposit. Obviously, if you're a second and subsequent buyer, then the deposit will be a minimum of 20,000 or 20%. You can bring more to the table as a first or a second time buyer, but you can't get away with borrowing more. You can't get away with bringing less to the table. So the loan to value, which is in this example 90%, obviously if it was 80,000, it would be 80%, so on and so forth. It's a little bit harder to explain that concept. If I'm using a mortgage of 380,000, people tend to get lost. So how much can you borrow? Again, there's fixed rules out there in relation to the multiple, but first time buyers borrow up to the 90% of the value, which means you need the 10% deposit. So again, a 300 grand property, you'd need a 30% deposit, 30,000 deposit minimum. If you have more, great. Obviously, if you take on board the costs that I'm after mentioning, you know you're going to need more. On a 300,000 property, you'd probably need close to 35,000 euros to cover costs, legal fees and outlay, actually a little bit more than 35. Okay, you have what's called the help to buy scheme if you're buying or building a new home. Okay, that's where it's only applicable. Again, property price up to 500,000 and minimum loan to value, so that means the loan has to be 70% or above. Okay, the value of the help to buy is currently 30,000 up until the end of December. Again, we're seeing an awful lot of interest for individuals looking to buy new builds. The challenge is actually finding the new builds and if there's availability. If you're a second and subsequent buyer, you can borrow up to 80%. Same scenario, a 300 grand house, you need the 60,000 deposit. And if you're an investor, it's 70%. So a 300 grand property, you have to bring 90,000 to the table. Okay, so there are the three types of scenarios that you're looking to buy. Okay, How much can you borrow is a multiple. So it's there just on the slide. It is three and a half times your combined salary. So I'm earning 40,000. My good wife is earning 60,000. So we're have 100,000 euros between us. So the income multiple, as in how much we can borrow, subject to repayment capacity tests and all the other tests, will be a maximum of 350,000 euros. There are what are called exemptions or exceptions that the banks apply from time to time. Right now, the first time buyer, what's called the loan to income exemption. Again, I'm going to cover it next week or the week after in the next presentation. But there are different types of exemptions where you can borrow more than 3.5 times, or if you're a second and subsequent buyer, you can borrow more than the 80%. Again, it's quite difficult to get those off the banks at the moment, purely because of this situation with COVID. They definitely have clamped down on the prevalence or the availability of those types of mortgages. But they typically will come out at the beginning of the year. The banks will be quite active with them for the first 3 to 4 months, and then it tends to slow down as the year goes on. Okay. Again, just a tip: if you are looking for an exemption or an exception, watch it towards the end of this year. If the banks have scope, they will definitely take advantage of it, because again, they're all out to make the profit. Okay. Purchase price example on an AIP of 350,000. So what we're doing here is giving an example of what deposit you would need. So if I have AIP for 350, it doesn't mean I use it all. So again, we get asked this all the time: do I have to use the 350? You don't. Again, you would assume it's self-explanatory. So in this example, I'm taking a mortgage of 270, 315, or 350, and the house price varies from 300 up to 450. You'll see at the bottom there, the 400,000 property, I need the 50,000 deposit, and the 450,000 property, I need 90,000 deposit, because my mortgage in this example will be capped at 350. So the amount that you draw down from your AIP depends on the value of the property, but it's capped at that figure. So if you get AIP for 300,000 and then you subsequently want to buy a house for 500 and you don't have the cash, you need to get a higher AIP. And if you can't qualify for it, then you're not going to get it. Okay, so more savings, or find a lower priced product. Okay. To give you an example of repayments and the difference in the repayments. So again, there's a lot of examples in this. It came off the CCPC website. Very simple for you to do this yourself, but it's a mortgage of 270, 315, and 350, whether you go with the 25 years or 30 or 35 years. So you can see the difference in the repayments. So even over the 25 years, the 350,000 mortgage, while it is about 300 euros more expensive, the benefit to you is how much interest you pay, because that extra payment is saving you in interest. So to put it into context, using the top line there, the 350, if I was paying the max term versus the max term of 35 versus the 25-year example, it will either cost me, in a monthly basis, it will cost me 318 euros more, but it's going to save me over 54,000 euros in interest. Okay, so just let that settle. So it'll cost you 318 a month, but you'll have saved 54,000 euros in interest. This is assuming interest rates haven't changed over that time frame. So they stay static at 2.5%. But ultimately, if the interest rates go up, they go up for the 25-year product and for the 35-year product. In fact, that would make the 35-year product more expensive again. Okay. So just to put it into context there, the savings can be quite significant. Okay. Equally so, what would happen is if you took the 25 years, and we explain this to our younger clients all the time. So if you take the example we've just done, and let's use the 315 as the sample. So I have a 315,000 euro mortgage for 25 versus 30 versus 35. So you can see the numbers there. And then the cost of that. So the figure I have there is the interest that you've paid back to the loan, to the bank on top of the loan. So it's 315 plus the 108 plus the 133 or plus the 157. So that's the interest that the bank makes. Okay. So the example is if you pay that extra 287 euros a month. So what are you getting? Well, you're mortgage free at 55 instead of at 65, for example, or at 60 instead of 70. Equally so, if you decided at that age to keep saving that mortgage, so now you're 55 and you're deciding, you know what, I've paid my mortgage off, I was smart for the last 25 years, now I've got 100, 1,000, 1,100, 1,400 euros a month free, keep saving it or keep saving some of it. In this example, if you kept saving the full whack at the end of the 35 years, so your mortgage is gone at the end of 25 years, at the end of 35 years, you'd have 135,000 euros in cash sitting in your account. That wouldn't be too bad. So mortgage cleared at the end of 35 years, or 135,000 euros sitting in cash. Now you have had to overpay the mortgage for the 25-year period, but you can see the difference that it can have by doing something very, very small. Okay. So which bank is right for you? They're all the banks that are available. The one that I didn't touch on was the Rebuilding Ireland. So Rebuilding Ireland is very specific if you think it's for you. So again, it's capped at salaries, it's capped at property prices, and it is a very, very specific product. You have to have been declined by 2 of the mainstream banks for Rebuilding Ireland to take you on board, but it's there and it is available. Okay. So when I said to you before in relation to the mortgages that are available and the different products that are available, this is our own proprietary sheet. We update this every week or every month as the banks change their rates. We go through it with the client. This is literally every mortgage product that's available out there. Obviously, I'm not going to go through it, but the reason we use it, number one, that we're on top of what rates are there, it's to give a snapshot to clients that how could you possibly make that decision on your own. That's basically what we're trying to get across. Okay. Now let's have a look. So I'm going to get into the calculators and start explaining. Again, I'm not going to be going into this in a huge amount because over the next seminar, I'm going to get into it in a lot more detail. But just to kind of put it into context, so I'm buying my house for 350. So hopefully everyone can see this now. I'm buying my house for 350. I am borrowing 315 over the 2.5 years with a term of 35. Okay. Things that you might forget about is local property tax. You have house insurance and you have mortgage protection or life insurance. Okay, so the bank expects you to have life insurance on the mortgage in the event that you die or your partner dies, the mortgage will be cleared. Okay, again, will be covered in the next seminar. So when you add all of that to your repayment, you actually have principal, interest, taxes and insurances. So in that example there, the monthly repayment before you pay your utility bills and furnish the place will be about 1,250 a month. So it's not just the mortgage repayment, it's these additional costs that you will have on top. Okay, again, they'd be fairly accurate estimates. So the example there is 35 years. If I drop that to 25 years, the monthly repayment goes up to 1,400 a month, and the total cost estimated will be about 1,540 a month. So if you're paying rent, so this is where we use this figure here with our clients. So how much rent are you paying? Okay, let's try and keep it as close to the rent as possible. So okay, you're paying 1,500 euros a month in rent. Then we can get your mortgage at 25 years. What have we just saved you in terms of interest? So the repayment on that in terms of interest is 108,000. On the 35 years is 157,000. Okay. So just to put it into context, that's a 50,000 euro interest saving that you're either going to give to the bank or you're going to take advantage of yourself. And it's all driven by what's called amortization. So amortization is the little magic word, how mortgages are structured. Again, I'm not going to get into it in any great detail today, but just again, a takeaway in case you don't log on the next day. This individual, and I'm going to go with the 35-year term, this individual borrows the 315,000 euros. Their interest is in this line and it reduces from the first month, and then the principal or the capital repayment will increase from the first month. But just to show you, in that first 12 months, this individual will have paid just over 7,800 euros in interest. So it sounds like a significant amount because it is. Okay, and the interest that they'd pay in the last 12 months, so 7,800, the last year, the interest to the bank is 181 euros. So when do you think the bank will put value on you? Obviously at the start of the mortgage. Okay, we'll get into that in a lot more detail the next day, but it's just to give you a snapshot and an understanding of where the profit originates from. The profit on a mortgage will typically be made, again, it's dependent on the term, but typically be made in the first 15 to 20 years. After that, the bank are very happy for you to pay it off because they've made their money, and then you can take the lump sum from your pension or an inheritance and clear it. What they don't want you doing is they don't want you doing it earlier in the mortgage. Okay, to go through a couple of examples with you then, there's no particular order in this, it's just the way it comes up in my slide deck here. It's KBC is the first calculator, just to show you how difficult this is. Again, the banks don't tend to show you this. Okay, it's John and Mary, first-time buyers. So I've pre-populated this, so if John and Mary are listening, you're welcome. So John and Mary, first-time buyers, but you might be a home mover, a switcher, an equity release, a holiday home, various options. again, the fixed rate, I've just gone with the 3-year fixed, but it could be 5, 1, 2, 3, 5, or 10. So you can see with KBC, there's no 7 or 4. And then urban or rural, again, KBC would tend to be a little bit more snobby there, but they will do deals. They will do deals out in the country, just maybe not too far out. So the loan we're looking for is 315. The purchase price is 350. I'm 35, so my max term is 33. So I'm going to go with the 33-year term. Okay. I'm single, no dependents. If you have dependents, it goes in there. Private sector or public sector, whether you're PAYE or self-employed. If you have any guaranteed allowances, or whether you have any variable income. So just to show you an example there, if I had a guaranteed allowance that was guaranteed part of my job, let's say it's $2,000 a year, and if I was getting a bonus and I can show over the last 2 or 3 years I get a bonus, but my employer says it's not guaranteed, I'd only get half of that included in the calculator. So it's 10 goes in, but they're giving me 5. Okay. Again, you could put in the 10 there, and you could argue it if it is consistent. But again, it's down to the duration you've worked with your employer. Okay. So my 60 and my 40, if you have any loans, they go in here. So car or credit union, they will go in here, and the monthly repayment goes in here. And that obviously impacts your net disposable income for borrowing. If you have an existing property and you don't want to sell it, it goes in that section. And then the bank say whether you're good or not. So in this example, they're saying, yeah, you're good to go, Mark. Just fill in the application. And the only test we need to look at is, can you afford this figure here, which is 1538. So can you show proven repayment ability in this example of just over 1,500 euros a month? Okay. In fact, with that example there with PTSB, a little secret, again, they mightn't tell you, they would accept if you could show about 1325. So they wouldn't look for the full 1530. Okay. The next example then, so that's as hard as it is. It can be more complicated, obviously, if you have variable income, if you're self-employed, if you've got other loans, and if you've got other properties. So everything is stressed a little bit differently. So where am I looking for? Bank of Ireland is next. So again, first-time buyer, 2 borrowers, dependents, 350, 315, max term 35. And again, come back to the term. Obviously, if you can go shorter, you can. House hunter or not. So are you property specific, or are you a house hunter? They have this mortgage repayment and then the stress repayment. So they show you both. And we need to match the repayment. Actually, a little bit less. So Bank of Ireland, this figure minus a little bit, and you're over the line. So 60 and 40, the same thing. Your demonstrated repayment ability or your proven repayment ability is, let's say, rent and savings. You have no existing property. Have you any financial commitments? So have you got a loan? Have you got maintenance, childcare? Again, it goes in different areas for the different banks. Again, you're within the rules. Off you go. Okay. And the last example I had was PTSB. Same example. Again, in this case, we strip down the proven repayment ability, so savings and rent, and that's your PRA. In this case, it's proven repayment ability, 166. Joint application, but you're both single, you're not married yet, 60 and 40. So a little trick with PTSB, for example, if we are trying to get a case assessed with a higher income, so if I put in 10 grand there as overtime or bonus, the same thing would happen. They're going to give me 50%. But if I can argue with the bank that they should take it all, again, it's based on maybe communication with your employer, an understanding of pay slips, going back over the previous 2 to 3 years to see what supports it. If you put it in as other income, then we get it assessed on a full basis. Okay. Again, potentially allowing the individual to borrow more. So again, car loans will go in here. If there's any credit cards, we put in what the amount is, and it'll generate. So you have an overdraft or a credit card limit of 3,000 euros. So we have to take 75 euros into account there. And then you have the existing property. So if you have an existing property and you want to hold on to it, it goes in there. Again, you're passing. There's different metrics and different explanations for these different titles or these different calculations. All the banks have their own little formulas, but ultimately in that example there, you've passed with the 3 banks. Obviously, everyone's information will be specific. So what goes in there, while that might seem very simple, there's quite a bit of groundwork we'll go into figuring out what will and wouldn't work. Okay, so getting back into the presentation then. So I've just gone through how it works. So in relation to Symmetry now, I'm going to sing our own praise here. I think I deserve it. but this goes to all brokers. I'm not naive to think that everyone is going to use Symmetry as the mortgage broker, and I wouldn't be able to facilitate all mortgages if everyone did, because we are limited to 8 staff. However, we represent our client. We don't represent the bank. We understand what all the banks offer, as would any good broker. You should be contacting with that individual that you're dealing with on an ongoing basis. It's quite a stressful period buying your first home. Again, even a good broker should even help you evaluate the property, and then provide other additional services, which I'll touch on at the very end. Meetings, so our meetings done on Zoom or done face-to-face. Brokers get paid by banks. Again, just that you are aware, it may not be fully disclosed if you're dealing with a broker, because a lot of brokers do charge fees. We don't charge fees. We operate on a referral basis. So we basically say, if you like how we do business, you think we're good at what we do, we just ask you to think about it next time mortgages come up in conversation. And invariably, it stands us in good stead. But all brokers get paid 1% of the mortgage the month after it draws down. Now, we do earn it over a 3-year period. I'm not going to get financially technical on stuff, but we do get 1% of the mortgage post drawdown. We're motivated to get the thing closed, no more than yourself. You want to get your keys. And again, most brokers, and again, in our case, we definitely have discounted arrangements with various different providers. Conveyancing is the legal fees. So we have a panel of solicitors that we operate with. We have discounts with different insurance companies. And then we have partnerships with various trades and services, which is where I'm going to wrap it up. So in terms of getting the house painted, getting the boiler replaced, getting the electrics upgraded, getting the garden redone, new tiles, new bathrooms, getting an interior designer involved, energy procurement, legal services. If it's an investment you're going for, you've got the tax complications, getting a deep clean done if you're buying a second-hand home. If you're buying a new property, you need it to be snagged. Again, we have the services there. If you're buying a second-hand home, you'll need what's called a survey. It's advisable you get a survey. You don't have to. Again, we've got discounted rates on all of these services. Okay. That's it. So in terms of the questions, and I'm pretty much bang on. We started about 2 minutes late, and my clock is saying 46 minutes. So far, only 2 questions. The slides, yep, I'm happy to share the slides if Dylan is happy to share the slides. I don't think there's any problems there. And then Connacht Rugby asked me, come on Connacht, up the west. As a first-time buyer, will it be difficult to get a mortgage on a fixed-term contract? Excellent question. It depends on the duration of the fixed term contract. Equally, it depends what you were doing before that contract. So, for example, if you're an IT contractor, what were you doing before the previous contract? We deal an awful lot with people on contract. It depends on that particular job, okay? But you should definitely be able to get a mortgage on a fixed term contract. If you're in the public sector, you're home and hosed. There wouldn't be a problem if you're on a contract in the public sector, so long as you've got at least 6 to 12 months under your belt. And then what you do there is you play on the individual's career. So what have they done to date? Give them a little bit more information. On your background, so they get a good picture of the person looking to borrow. Who are they a good bet? So the bank are basically looking at the application. Are you a good bet? And how we address that. Again, I didn't mention it as part of the application, but a part of the presentation is a cover note. So all applications have, you kind of think about it, so you have all of these documentations and all these bank statements and pay slips and credit card statements and loan statements, salary certs. It all goes into a big file, and it's actually scanned up with the banks now. Then the banks, basically, it's sent over to them. What we send them, it's like a jigsaw. What we send them is the instructions. So it's like your nephew and niece or child at home. They're taking out their 48-piece jigsaw. 3 kids at home, so I know all about it. They look at the picture and then they try and copy the picture. In mortgages, the picture is our cover note, and the more detailed and the more direction we give, the easier it is for the underwriter to make an assessment. So we'd spend an awful lot of time putting together quality cover notes. Yep, slides, that's fine. The rule of thumb, I was told, this person could get finally maximum mortgage. Is that? Yes, that is accurate. So 3.5 times is the central bank rule. So what happened was the central bank didn't trust the banks to make their own decisions. So they brought in rules to cap how much the banks can lend. It's 3.5 times, but that varies. So for example, if you're on the lower salaries, you may not be able to borrow 3.5 times, because when you take into account minimum disposable income requirements, individuals on 25,000, 30,000 euros might find it hard to borrow 3.5 times. and they certainly wouldn't qualify for exemptions. If you're looking at the exemptions or the exceptions, you certainly can borrow more than 3.5 times. It's generally up to around 4.5, but some banks don't put a cap on it. However, the exemptions right now are not, I'm going to say they're not open. I know 1 or 2 banks are opening exemptions for second and subsequent buyers. If they want to borrow more than the 80%, they're back in the market. But the first time buyer, what's called the loan to income, the 3.5 times multiple, that hasn't changed. Can you borrow more than the house is worth with the intention of carrying out renovations? Can you spend what happens if you sell before the final payment? Okay, so can you borrow before the house, more than the house? No, you can't. So you're capped to borrow the 80% or 90%. Again, let's say 90% as a first-time buyer. However, if you're going to carry out renovations, what you do is you get what's called the cost of construction completed by a builder, or an architect, or an engineer, estimating what work is going to be carried out. We would then submit that to a valuer as part of the process. Again, I'm talking through the mortgage process, and it's next week or the week after, so people understand what's going on when you're buying a house. But there's a valuer involved. So the valuer says the house is worth 300,000 euros today, but with this cost of construction, it's going to be worth 400,000. So now the bank will be happy to lend up to that 400,000 euro figure, but they'll do it in stages. So they're not going to give you, in this, let's say it's 400,000, they're not going to give you 360,000 euros off the bat. They'll give you 270 to buy it, which is 90%. And then the additional 90,000, they'd give it to you, let's say, in 2 drawdown stages via your solicitor, once the works have been confirmed, subject to the valuation, the renovation and the new valuation satisfying it. So if the valuer said with the works, it's still only worth 320, 330, so it's remedial work, but it costs a lot, but it doesn't increase the value, then unfortunately that would be a deal you need to be careful on. Again, we cover all that type of stuff as a matter of course, Vincent. So if there is that type of example, my details are there, okay? Debbie, should you cap your spending before providing the 6 months bank statements for an application? Yes and no. So proven repayment ability, it's not, yes, we go through bank statements and you do see some funny stuff. Over the last 10, 15 years, I've seen some stuff that really cracks you up. Friends having fun with friends. But in reality, the 6 months, so long as you can show proven repayment ability, whether that's through savings and or paying a mortgage. If you're spending the rest of your money in Next or online, or you support Liverpool or Man United and you go over every fortnight, it doesn't matter, so long as the core repayment capacity or repayment ability is demonstrated separate to that expenditure. Don't gamble, obviously. If you do gamble with cash, but ideally it wouldn't be a good habit. Coming from a financial advisor, I couldn't endorse it. But don't do silly things. Try and keep gifts and financial transactions between yourself and family to a minimum. We have a division called Agent Financial, so we deal quite a lot with individuals coming to Ireland and working in Ireland from abroad. And there is a prevalence among certain nationalities to lend money to each other. Again, it makes a mortgage application complicated, and you're either telling them to clean up their accounts for 6 months, or if we think we can explain it to the bank, we'll come up with a suitable cover note to ensure that the underwriter will accept what's going on. So I hope that answers your question, Debbie. I don't think I've missed any other questions. Great. So if that is it, and no one else has any other questions, hopefully you found it useful. And if you did, mention it to your friends and colleagues, and feel free to reach out to us if you think we can be of advantage and help to you. Okay. Dylan, I'll sign off now. I don't think there's any more coming through. So thank you very much, everybody. And I hope you have a great rest of your Tuesday afternoon. Okay. Bye-bye.